Hey guys, welcome back to the channel. Today we're going to be discussing public limited companies. So I've made tons of videos in this series about the different organisational structures that a firm can take, and that's covered in the level 1 corporate issuers section of the curriculum. We've discussed sole proprietorships, all the different types of partnerships, private limited companies, and now finally we get to public limited companies. And public limited companies are definitely one of the most distinguished types of structures because you've got liquidity in terms of the shares that can be actively traded. You've got a different tax structure. You've got double taxation, which differs to pass-through taxation that we've looked at elsewhere in all the other different types of structures. So yeah, without further ado, let's crack on and discuss public limited companies. Okay, so before we start, a very quick refresher as to what limited companies offer, how they differ to sole proprietorships and partnerships. I've covered a lot of this in the previous video that I did on private limited companies, but let's quickly just run through these points again because they're still important when we think about public companies. So yeah, limited companies offer the following advantages over sole traders and partnership. So access to capital. So yeah, public limited companies offer the ability to raise larger amounts of debt and equity capital. The volume of capital that's available to limited companies is vastly and considerably greater than what's on offer for sole traders and partnerships. You've got limited liability for all shareholders. So whether it's private limited companies, public limited companies, shareholders benefit from limited liability because in the eyes of the law, the companies and the owners are seen as two distinct entities. So yeah, the shareholders, the maximum amount they can lose from investing in a public limited company is their initial investment amount. They can't lose out on personal assets. The creditors can't come after their home if the company defaults on its debt, etc. So yeah, limited liability is a clear benefit of a company structure. Clear separation of ownership and management duties. So in limited companies, it's very common for shareholders to delegate the management responsibilities to the board and the executive management team, so CEO, CFO, and it's common for the shareholders to not really be that involved in the day-to-day operations of the business. And yeah, final point, greater ease of ownership created by using a share structure. So this is particularly relevant for public limited companies. There's an ability, if the company is listed, there's an ability for the firm shares to have greater price transparency, volume transparency, and there's a liquid market created where buyers and sellers can come together and trade in the company's shares, and that allows for more sort of dynamic shifts in ownership. And yeah, public limited companies are by far the most offer the most liquid ownership interest vehicle compared to all other structures that we'll discuss in the curriculum. So yeah, in most jurisdictions there are two types of limited company: the private limited company and what we're going to discuss in this video, the public limited company. So public limited companies present a structure that provides limited liability for shareholders and whose shares are freely traded and available to purchase by the investing public. So yeah, public companies differ to private companies because the shares are able to trade on a listed exchange. So the New York Stock Exchange, the London Stock Exchange will all include public companies which have share structures which are liquid and available to be traded amongst the public, right? I mean, me and you can buy shares in these types of companies. There's no real restrictions around who these buyers and sellers could be. The secondary market is open to pretty much everyone. So yeah, public limited companies have many of the same features as private limited companies. They provide limited liability to the owners. So I mentioned that the maximum amount that a public limited company shareholder can lose is their initial investment amount. They can't lose out on their personal assets, their home, etc. So limited liability is a clear benefit of a company structure. And yeah, segregation of management and ownership responsibilities. Shareholders will appoint a board to oversee the stewardship and the management of the company. Public limited companies have an unlimited number of shareholders and allow for unlimited transfer of ownership. whereas private limited companies are more limited in terms of the size of the shareholder base and the ability to transfer shares. So yeah, public limited companies, you can have any number of shareholders within the business. You know, you can, like, for each share, you could have a different shareholder, pretty much. And there's no restrictions around ownership transfers, or much lower restrictions around ownership transfers. Whereas you look at a private limited company and there needs to be sort of a transaction and diligence that takes place. It's much more complicated transacting private company shares due to lack of disclosure. So yeah, private companies are much more limited in terms of the size of their shareholders and their shareholder base. Public limited companies are much more suitable for firms that want their shares to trade publicly. It offers greater visibility. There's sort of a reputational boost that a company gets from floating and going public. Like I said, there's greater visibility. There's sort of higher standards that the company needs to adhere to, and if the company does adhere to them sort of successfully and well, that there's kind of like a gold stamp and a reputational kind of advantage that comes with that. And the type of company that will adopt a public company structure is typically one that's achieved significant scale, has a large revenue base, and significant assets. Now, when we think about disadvantages for public limited company structures, it all comes down to tax. So public limited companies differ, and this is really important. They differ to all the other types of organisational forms we discuss because of their taxation. So public limited companies are subject to double tax. They're taxed twice, once at the company level and once at the shareholder level. So all other structures, the partnerships, the sole proprietorships, the private limited companies, were only taxed once. They were taxed on the business profits at the owner's personal tax rates. That's not the case when it comes to public limited companies. So this structure, this approach to tax, is known as double taxation, where the company is taxed on its profits and the shareholder is taxed on the dividends which they receive and are distributed out of the company's post-tax profits. So the company generates profits, those profits are taxed at a corporate income tax rate, and then those profits, whatever's left after the tax has been paid, the post-tax profits, a dividend can be paid out of that, and that dividend is taxed at the shareholder's personal tax rate. So there's two layers of tax. And what that means is there's often an incentivization for public companies to reinvest their profits. So by reinvesting profits, you're subject to the company tax. You can never avoid the company tax, but you can avoid the shareholder tax. So management can withhold a dividend, not pay out a dividend to the shareholders, and that allows the shareholder to avoid paying a personal income tax on the dividends that they receive. So let's just do a quick sketch so we're clear on how this works. So we've got private limited company, all other business structures. So, how does a company work? It generates sales. Those sales create a profit for the business. And then the business will distribute those profits to the owner in the form of a dividend. And that's the same for both. Pretty much the same for both. The business will generate sales, which will convert into a profit, we hope. And then the profits will be paid out to the owners. So regardless of the structure that we adopt, that's basically how any business works. Now, in a private limited company scenario, the profit that the business generates is taxed. It's taxed at a corporate income tax rate, and then also the dividend is taxed. So that is the double taxation effect. The profit's taxed at a corporation tax rate, and then if the business decides to distribute out a dividend to the owner, that's also taxed. So there's two layers of tax. Whereas in all other business structures, the profit is not taxed. There's only one layer of tax, and that is business profits that the owner receives are taxed at their personal income tax rates. So you can see, comparing the structures, this is the key disadvantage. Sorry, this should be a public limited company, not a private. So yeah, in a public limited company scenario, you are taxed twice. In all other business structures, you're only taxed once. So yeah, public limited companies are therefore a very attractive structure for companies looking to retain profits, to fund their future investment, and less attractive when the owners want a high amount of dividends. So if a company is looking to reinvest its profits and grow and not pay out a dividend, then public limited companies are a great structure because you're only going to pay the one layer of tax, which is the corporation tax rate, which are typically quite low. Like corporation tax rates tend to be low. If the objective of the company is to pay significant dividends out to the owners, then public limited companies are a highly unattractive structure because you're going to be paying double tax on all your profits, and dividend tax rates can be cumbersome. It sort of depends on the jurisdiction, but like if you're paying two lots of tax, you're going to end up with a very high tax bill. So yeah, that's everything I wanted to discuss in regards to public limited companies. I hope that was helpful. Yeah, the key differentiators between a public limited company and a private limited company are the liquidity of the company shares. So private limited companies are highly illiquid. There's no real market that allows for ownership transfer, whereas public limited companies, typically the shares trade on an exchange, which creates price transparency, volume transparency, and a liquid market for buyers and sellers to sort of transfer the ownership of the company. Access to capital as well. You know, public limited companies basically have unlimited access to capital because they can have an unlimited number of shareholders. They can always issue new equity if they want, always bring in new shareholders, providing the dilution isn't too unattractive for existing shareholders. And tax, like public limited companies, can be a really, really unattractive structure if you want to pay a high level of dividends to your owners. You know, the double taxation effect just can be incredibly expensive from a tax perspective. So yeah, they're the main considerations. Hopefully that was helpful. I'll see you guys in the next video.